Good morning, real estate mindset community, and happy Friday. Congratulations on making it this far in the week. Just a little bit to go before the weekend hits. So, got a lot to cover today. Have a couple charts that made ridiculous movement, kind of mind blowing. I'm going to pull those up first. But first, I want to address just a couple comments that I get about my morning lives. A lot of people, that appreciate my content, not the haters, but the people that appreciate my content, a lot of them, some of them tell me, the morning lives are too long. So I wanted to reassure you guys that, I'll go back and I'll put chapters on my lives if you want to come back here, but our lives are designed to be a lot longer. For a few reasons. It gives us the ability to continuously keep our hand to the pulse of the housing market so we can watch certain data sets day over day if we want to. The second thing it does is it allows me to try to help empower you guys as consumers. And the third thing, and this is probably the thing I love most about the lives, is it helps us to build a bigger supportive community. And the emphasis and the key there, you guys, is on the support. I hate when the bickering and the trolling, but it is what it is. It's a free country, whatever. So I'm going to try to keep this video extremely efficient, extremely to the point. And we're going to start right now, you guys, by doing our market update. And I'm going to show you guys some and also good morning. I see everyone in the chat. Thank you. Oh, Bernie's still there. Christy, Bernie's still there. You want to see Bernie? You see Bernie? Bernie's right there. Constant reminder on how far we've come. Anyways, guys, we're going to go right into our market update. And I want to show you guys the inversion of the 10 and the 2. You guys, take a look at this. Okay, take a look at this. Okay, starting with our house market update or market update in general. Take a look at this, guys. This is just, I'm getting goosebumps. I'm getting freaking goosebumps because it's like, dang, like history is like playing itself out here. It's like history's right. The market's wrong all the time. It's like the greed this time is different. But this is working. So it's really, really shocking and fascinating to me. But the inversion of the 10 and the 2 right now is only 16 basis points, you guys. We are only 16 basis points from reinversion. Why is that important to understand? Because generally it's about 6 months. Generally it's about 6 months after reinversion before recession hits. Okay, and you can see that like the inversion right here, and then the reinversion was like September. So look, that's about 6 months as well. It's crazy how it's about 6 months. So if this reinverts, you guys, that's a big, big deal. That means the economy, the recession is knocking at the door. What's very, very astonishing is about the uninversion right now. It's not reinverted yet, but it's uninverting. It's being done by the long end of the yields, not the short end. So this is the first time in history that we will have uninverted because of the long end, excuse me, of the yield. So very, very interesting. And another thing that blew up yesterday, and I don't know why. Look at this, guys. Remember how often I'm talking to you guys about the 5-year break-even inflation rate and about how important it is for the Federal Reserve? Jeff, fill me on this one. I see you, Jeff. I see you, Jeff. I love you, Jeff. Where you been, bro? Where you been? I love you. But anyways, here's a 5-year break. You guys keep me going. You have no idea how much. I'm just a normal person, man. I'm just a normal person. You guys keep me going. But listen, 5-year break-even inflation rate. Holy smokes, you guys. What we're seeing right here is what the Fed does not want to see. You know how we always hear the Fed saying we don't want to see unhinged expectations of inflation? Look at this, guys. Look at this skyrocket. Like in 2 days. So it was like, remember, it was like at a new low almost for like the last few months. In what was this, the 5th? So in 2 weeks, you guys, it went from 2.14 to 2.5. That's why. Like, I don't know why, other than the fact that we have more data that came out with the labor market and with the inflation battle that's worse. So it appears like the inflation is going to be here for longer. It appears that the rates are going to be higher for longer. The Federal Reserve has been saying this the whole time, but now it's the market starting to get it. I think what's happening here is we're starting to see all of this work sink its teeth in. But having said that, we also got issues with inflation still. So even though we have these cross currents, things aren't broken enough for deflation or deflation. We're not talking about disinflation. We really want to see deflation for the prices, not disinflation, which we haven't seen either of them after February of this year. But look at that, guys. That's a huge problem for the Fed. This right here, I'm going to tell you guys, this right here puts to me, when I see something like this puts a rate hike potential for December and even possibly November. Even though the market's pricing out of a November rate hike, the expectations for inflation 5 years from now, you guys, This is getting unhinged. That's crazy. In 2 days, look at that. Like, look at all the work that, they made all this work. It's going down, kind of staying safe. And then all of a sudden they're like, nah, inflation's real bad. This is crazy. I can't express to you how crazy this is. And I wish I knew exactly why this ballooned up, but this is something serious that the Fed will be watching. And again, this happened over 2 days. That's really, really remarkable. So let's go into the 10-year right now, you guys. Here's where the 10-year's at. It's actually, wow, it's down considerably right now. I did not see that until just now. Now, little bit on the 10-year. Yesterday, after hours, we hit 5%. We touched 5% after hours on the 10-year yesterday. That's insane. That's so, I was wondering if we were going to hit 5% in October, but like we already touched it after hours on the 19th of October. This is absolutely crazy, you guys. This is what is killing the economy. This is the economy killer. This is the 10-year treasury. A lot of things are tracking this. Specifically, what we watch is the mortgage rate. So we see this completely crushing the economy. Interesting, guys. Something happened at market open. So you guys kind of see it was going up right before market open. And then when market opened, this went straight down. That is insane. I don't know why. I was watching Jack's channel. I should have stayed on the market. I don't know why this did that. But regardless, you guys, we're still at 4.92. We're still at 4.92. This is crazy. So the 10 years going up. Take a look at the 1 month. This is the liquidity zapper. Do you guys see what I'm saying? So like when this goes down, like sometimes this will go up. All right. So probably people, it's just crazy that it's going up right now. But anyways, the 1 month treasury is where I have my money. This is the liquidity zapper. And I say that because there's a lot of people right now purchasing 1 month treasuries. When people purchase the 1 month treasuries, because the Federal Reserve is doing quantitative tightening, the Federal Reserve or the government will burn the money once you buy their treasuries. And that's the quantitative tightening. That's why we look at the reverse repo market. So right now, 1 month treasury, short end of the yield, 5.41%. This is the zapper. The reason why this is a liquidity zapper is take a look at this. This is the overnight reverse repo award rate. So we're sitting at 5.3. So in other words, what I'm saying is this rate, this 1 month, has to be over this rate, which is 5.3, in order for the liquidity to be drained out of the reverse repo market. Reverse repo market's like the excess savings. Now, there's a few reasons, why people think this is going down. Oh, thank you, Brandon. I see that, brother. I'm going to throw that up here in a second. But there's a few reasons why this is going down. But nevertheless, what I wanted to point out as far as the reverse repo market, you guys, is if we look to about May, right here, May 31st. Okay, so May 31st, there was $2.25 trillion. Okay. Less than 5 months later, we've lost half. In 5 months, half of the liquidity, half of the money in the overnight reverse repo facility is gone. In 5 months. That's a lot. Now, a lot of people are saying, no, the money's going to come back, but it's not. It'll come back a little bit when they mature. But, there's a few reasons this is going down. Some people are also saying depositors are fleeing the banks, going into treasuries. But regardless, you guys, this is really a lifeline right here. This is what I'm saying as a lifeline. If you take this away from the economy, I think we crash. I think we crash hard. So keep your eyes on this. We want this to go down. There are some people that think this is going to go down completely by this year. When I look at it, it's hard to believe that. I mean, maybe, but it just depends on what happens with this right here. If this sucker gets to like 5.5, that money's gone. This money right here is going to be gone. So let's see what the 10-year, what effect that's having on mortgage rates. Take a look at this, guys. A new record. So we got a new record high mortgage rates. We're sitting at 8.03%. That's the highest since the 2000s. This is the new record high for my career. And now we've had higher interest rates, but not during this cycle and not during my adult life. So this is a new record high sitting at 8.03. That is an astonishingly high interest rate because this is like average, decent, like good credit, right? So that's pretty high, don't you guys think? Now, take a look at the amortization schedule. I'm going to be very fast in these things. Again, I want to make this fast for the people that don't have too much time. This is our amortization schedule. One point I always try to make about mortgage debt is it's really, really expensive to buy a home, especially with the first 10 years. So you know how we always hear people move in the first 5 to 7 years? That's prime time money making for the lender. So if the average person is moving 5 to 7 years, they're literally not paying like almost none of their principal down. Almost, not all, but almost 100% of their payments go to paying the mortgage. Okay. So when people demean you or, me or whoever, and they're saying, oh, you're renting, you're going to get trapped renting. It's just like, y'all, you're going to get trapped paying $540,000 in fees. So I'm cool renting. You guys know what I'm saying? But anyways, guys, at 8.03, if you get the average loan amount of around $328,000, the total amount of fees you guys will pay, $540,000. Now, I believe that once we have enough money saved after we close, after we put our down payment, we should start attacking the amortization schedule. And the sooner we do that, the better. But if it takes us 2 years, so be it. It's okay. But you have time, is what I'm saying. Now, if you close, okay, you close on the loan, your first payment begins, and you guys want to pay down 5 years of your loan. It only costs, now we're not under $16,000. We're so close. It only costs $16,086. We're making a lot of progress here. So you pay $16,000 down on the principal of your mortgage, and you skip all of the fees highlighted in blue. All right. The total amount of those fees is $128,000. So you pay $16,000 towards your principal in the first year. You save 5 years and $128,000. I hope you guys hold on to that for the rest of your life. Now take a look at this. Here's the affordability calculator. I want to show you guys the damage of consumer debt, being that we have a new record high interest rate. So say that we have a family household that makes $100,000. First of all, that's above average. So we're taking above average people. All right. And let's say their average debt is about $1,400, which is disgustingly accurate. So if we change this again, remember change, if you guys want to come here, go to change this to 45%. I put in the HOA, 18% down payment, which is average. I calculated this, and the average household that makes $100,000 only qualifies for $287,000 as long as they have an additional $60,000 down on their house. However, if this same people had no consumer debt at all, their affordability goes from $287,000 to $461,000, so long as they have that higher down payment, because it's a higher amount of $96,000. So don't forget, guys, we can't just get a house if we want one. You got to have a whole bunch of money down sometimes, right? Depending on the loan and depending on if the seller's going to pay closing costs. But regardless, you guys, again, that's huge, right? That's a difference of $174,000 or 60% purchasing power. So really, really important stuff to understand that. Like, they don't teach this stuff, you guys. They don't want you to know because they make money off of you. Now, real quick, Brandon, we're going to go into our first video, but Brandon, I appreciate you, brother. Super big fan. I love your heart and honesty. I'm trying, man. And I put a little bit too much of my heart out there. I get it. I shouldn't do that. It really burns me out. You should look at Kyle, Texas new builds. Are outnumbering resale and number of active inventory. Prices are $100K cheaper than all surrounding cities. Not only that, in Conroe, there's more new homes than existing on MLS. It's crazy, man. It's crazy. And not only that, Brandon, like, understand how bad it is with new construction. Like, normally when you appraise a house, the appraiser is supposed to remove any seller concessions. So like, if I bought an existing home for $400,000, but the seller pays $10,000 in my closing costs, the home would appraise hypothetically for $390 because you got to remove the $10,000. They don't do that in new construction. And on top of not doing that, they're also reducing the prices 15 to 20%, offering a 4.5 now, I think it is, with the NAR, and $10,000 back in closing. They are throwing and rushing people into these developments. Is really, really crazy. And I want to do some update videos where I'm going to drive around just like a 15-mile radius around my house. And I'm going to show you guys like 8 different new home build communities that like have hidden inventory. Good morning, Johnny. I was wondering if he was going to make it today. Good morning, brother. All right, guys, we're going to get started on our first video. First video is going to be Jerome Powell. He spoke yesterday. I was going to go live and I was going to cover it, guys. But again, man, I mean, I've just been so burnt out. I've been really, really overwhelmed. Hopefully, is my picture okay? Looks like my picture's not okay. Anyways, guys, I've been super overwhelmed. It's been a couple of days. It's been really hard to get out of bed. I was just so overwhelmed with all this data. I just needed a break from my brain. I don't even know why I'm telling you that. But we're going to listen to Jerome Powell right now. This is his talk yesterday. It's only about 5 minutes. A couple things he's going to go into that, Charles, I appreciate you, man. I'm going to bring that up in a minute. A couple things that he's going to go into is the strength of the housing market. And also, guys, we still have COVID money being pumped into the economy. We still have COVID money. So he's going to talk about that. He's going to talk about the lags. He's going to talk about stuff like that. But this is basically the summary of what Jerome Powell said yesterday. So guys, let me know if the volume's okay.
Given everything that's going on in the world and in the economy, there's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today, we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, you know, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house. Quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control. They come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable? And where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
So there's no precision in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
Yeah, and he's not wrong, you guys. I mean, the demand has been persistent, but also the sentiment changed. And I believe a big reason that is the Fed put. Now, let me show you guys this. So really without this, the economy is not strong. Okay, this is all the extra money. This is the reverse repo. So it's not really strong because there's lifelines propping it up. I think a strong economy would be an economy that was able to grow without this, right? And consumers would be strong, without 70%. I mean, how could people say that consumers are strong right now when 70%, 60-70% spends, which you look at, Americans are living paycheck to paycheck? I mean, the thing is like the upper 1% are talking about the economy in the world as if it was only them living there. What about the other 99% of people like me and you that are like at the bottom, near the bottom, struggling to find a home? You guys, here's the thing. I don't even want to become a millionaire. I'm not even interested in becoming a millionaire. I want to own a few more houses. But dude, at this point, I just want a freaking primary residence for my family and I. And that's really all I don't even care about anything else. I just want to do that part so I can move on. So I understand the frustration. I understand all that. But nevertheless, you guys, it's still really important to be safe and I think risk off. So Charles, thank you for the super chat, brother. I'm working out, man. My arms are a long way to go. I love you, man. Always nice to hear from you. Appreciate the support. And I did see Jerome Powell get interrupted by climate activists yesterday. And honestly, guys, it's like, how the heck do they allow, Jerome Powell is an important person. How did a couple, activists break through security and get like feet away from Jerome Powell? To me, like that's even more scary than what these activists are saying. It's like, where's security? Like it looked like there was like women pushing these people off a stage, like the host. It's like, where's the security at? I mean, we need Jerome Powell safe, man. Because thank God we have that 2% goal. If without that 2% goal, it would be really, really bad, you guys. Charles, thank you, my brother. We're going to get back into this right now. What do I have for you guys next? Let's look at the interest rates. Let us look at interest rates, okay? Boom, boom, boom. Oh, we looked at interest rates. Take a look at this. This is crazy. All right, so here's the VIX right here. You guys remember me saying that if I did make a move, I would go in VIX. I said that when it was about $13. It shot up yesterday. It's a little bit down today. Purchase. I hope you do have eventually. Thank you. Living in Omaha. Sorry, guys. I break focus sometimes. But anyways, guys, VIX is down, but it has been up. It has been up. Let's look at the 1 month. This is the volatility index. This is really kind of like the market accepting like what's coming. And I believe there have been people that said this has always hit 40 as we entered recession. I think I haven't researched it myself. If you guys want to research it. But apparently this hits 40 when we go into recession. Apparently, but these days everything is sideways. So I don't trust nothing right now. But that's VIX. You guys take a look here. This is oil. Oil has been making a juicy run. It's at $90 a barrel. Now, here's the thing, okay? Second war is happening. I won't get into that. I mean, dude, my heart is broken for all of the innocent people. But here's the thing, guys. As a result of this oil going up, that might be why we see this. Okay, and I'm being serious, guys. You guys need to understand how important this is to understand that inflation is becoming unhinged. I'm asking myself, how is inflation becoming unhinged when the market is clearly starting to break apart? So the market's clearly starting to break apart, but we still got inflation in this graph, you guys. Oh my God, I'm telling you. The Fed is all messed up because of this right here. This is bad. This is bad. It's probably a result of the oil. I don't know 100%. I'm trying to look at the comments, but I can't. Here's the Dixie, you guys. This is the dollar. I mean, all the people that think that's, they're going to replace the dollar with bricks, the whole bricks thing. They're not. There's nothing capable right now to replace the dollar. 10 years from now, 20 years from now, maybe, right? They're doing a lot to try to de-globalize the dollar. But right now, there's nothing. There's no way, in my opinion, that you're going to be able to replace this dollar. I mean, the dollar's stronger. It's honestly, the more over 100 this is, the more it hurts the world. Literally, the dollar hurts the world. It's very interesting. So we're going to go into our next video right now. And our next video is kind of on what I just talked about, and it's on what Jerome Powell said. Essentially, you guys, the economy is strong, even though they have that lifeline, reverse repo, and other things, and COVID money printing. The Fed's not done. So I want you guys to understand, all of the, date the rate, marry the house stuff, all of you can refinance later was total poo-poo. It was total nonsense. All of those realtors, all those little lead generating realtor channels, especially ones in Phoenix, oh my gosh, and in California, geez, you guys, they were wrong. You guys, we're going to have high interest rates maybe into 2025. And honestly, I doubt they'll ever be under 5%. I'm talking about mortgage rates. I don't want them to be under 5% personally. We need them elevated, but you guys, we're going to be here for a long time. Now, understanding we're going to have elevated interest rates and the lack of any equity moving into the future is not doom and gloom. It's probably, there's a high probability it will be a reality of what's coming. So what I say is adjust accordingly, right? Like certain things like cash is king, like stuff like that, right? Save your money, do all that type of stuff. Oh, I'm sorry, I pushed the wrong button, but I'm going to do our second video right now, you guys. I hope you enjoy this.
Thanks. In a speech or an opening statement that is, it turns hawkish, it turns dovish, the Fed chair says continued economic strength could warrant further tightening of monetary policy. Inflation, he says, is still too high. And he does note the recent string of stronger data, saying that recent data show resilience of the economy and the strength of the labor market. Why does that matter? Because he repeats his comment that a return to 2% inflation is likely going to require below trend growth and softening in the labor market. But before you think it's all hawkish, it is not. He goes on to cite risks of doing too little or doing too much with policy. He notes the stance of policy is restrictive, and it has helped to this point to bring down inflation and to reduce growth. He says because the Fed hiked rates so quickly, there may still be meaningful tightening in the pipeline. Financial conditions, he says, alluding to those high rates in the bond market right now, have tightened significantly and could affect monetary policy. An allusion to some of the comments from his colleagues who have said that because the bond market's doing its work for it, the Fed may not have to do much. He doesn't say that exactly, but he alludes to it. He says the committee ultimately is proceeding carefully, will base its decisions on data and the outlook and the balance of risks. A little bit more on the economy. He says the data does show progress towards the Fed's goals of maximum employment and stable prices. He says the decline in inflation over the summer was a, quote, very favorable development. And he talks specifically about the September data. He said it did show a continued downward trend, but was somewhat less encouraging. Short-term measures of core inflation, he says, are now running below 3%. But he warns you, a few months of good data are only the beginning of the Fed getting enough confidence to come off of the rates that it has now. He said you can't know how long these low readings in inflation will persist. While conditions remain tight in the labor market, it is gradually cooling. He cites the decline in job openings, the reduction in the quits, and also the decline in the wage premium for job changers. Finally, he notes that geopolitical tensions are highly elevated and pose a risk to the global economy, calling the attacks on Israel horrifying. So, Frank, there you go. A little bit of something for everybody in there. I think ultimately what you walk away with is this idea of the committee is going to proceed carefully here, and it is going to take into account all of the data that's coming in, and there is no decision yet on what the next move is from the Fed.
You know, Steve, I know you're saying that's what you walk away with, but give us a sense. You've read the prepared remarks. In your mind, does it lean more dovish or hawkish?
I think it leans very neutral with an eye towards, what was it? Who was it? Clint Eastwood would sleep with his eye open with the gun under his pillow. I kind of think that's the way Powell's sleeping these days, and I think his eye is open for any inflation. But there is a bit of a warning here. If you take just those two comments, the economy is running strong, and you're going to need a period of below trend growth to bring inflation down. That tells you the chair has more to do. But you can't you can't run with that because of the other things he says in there about financial conditions are tight. There's additional tightening coming from the rate hikes it already had. And plus you also have this issue of geopolitical tensions, which he's really mentioned for the first time here. So I do think, look, here's what I thought going in. I thought the chair was going to take the time that the market was giving him to make up his mind. And by that, I mean, when you look at the probabilities, and I'll look at them in just a second, that showed the market did not really expect a rate hike at all. But to the extent it did, it was beginning to sort of go 50-50 for January.
Got it.
And in that there's no pressing need for the Fed to act or decide right now, I thought the chair was going to take the time the market was giving him. He's taking it, but saying, you know what, you're on notice. If we don't get the slowing, I may have to do more.
I mean, y'all hear what they're saying?
We challenged us.
Y'all hear? I mean, and also, do you guys think that Jerome Powell is doing a good job right now with the quantitative tightening? In my opinion, it's still a little bit too early to decide whether or not Jerome Powell is doing a good job. I will say right now that overall, I'm leaning towards not. I want to believe he's doing a good job, and I want to believe. And the reason I'm saying he's not doing a good job, first of all, because we're in this mess. Okay, so that's the number one thing. We're in this mess. But the bank bailout, man, the Fed put. If he's trying to break the Fed put, he's not doing a good job of that because they bailed out the banks this year. So although I am starting to appreciate what he's doing, which is basically keeping us boiling alive without us knowing that, just like Ben Bernanke. So it's still a little bit too early, but I'm going to go on the side of like, I don't think he's doing a good job. Okay. I think I'm leaving more reservations that he is, but overall with the Fed put this year, I don't say it. Take a look at the CME Fed watch real quick. Let me remove this comment. Oh, I got another, Steve. I'll get right back there, brother. Okay, I'll get back to that. Take a look at, let me pull the comment off there. I'm sorry, guys. Take a look at CME Fed watch. This is what the market thinks the Fed's going to do next. Let me see if this is refreshed. This changed significantly yesterday after all of the Fed officials started speaking. So there's a significant change. Now, as far as this, an additional rate hike in November, the market is saying not going to happen. Only 1.4% saying another rate hike in November. So that is dead in the water. Basically dead in the water. Take a look at December. Huge movement here as well. So they're basically writing off. And 2 days ago, this was at 40%. So only 2 days ago, it was at 40%. Now it's at 20%, which brings me back to the 5-year, inflation. Like, why would this rise like that then? If the market doesn't think any more rate hikes, look at the market's expectation of inflation. That is going in the opposite directions of what I would have thought they would have run with, right? So the market's saying, yeah, there's going to be inflation higher for longer, but no rate hike in December. Now, remember, I like to go out to June or July because we need to break 2024 home buying seasonality, okay? In order to do that, more than likely, as we've learned this year, we need rates to be elevated and everything else to continue to play out like credit tightening. But right now, you guys, is only sitting at 23%. So 23% likelihood that we will have rates where they're at right now or higher. So 23%. This got us high. I think it was close to 40, but now it's just way, way, way down. So really confusing signs from the market here, obviously. One hand, the market's saying risk off, like a lot of the market saying risk off. And then on the other hand, the most vocal people are saying risk on. All right, Steve, appreciate you, brother Steve. With housing markets frozen due to folks keeping their low mortgage rates. But also, that's not the only reason why it's frozen. Excuse me. It's also frozen because of the high interest rates, the 8%, but not just the interest rates, brother. Remember the price as well. But also remember the quantitative tightening, like the Fed is trying to destroy our jobs, right? So there's many factors is my point, but the golden handcuff, which is what he's talking about, is a real thing. Are we seeing increased demand for oh my gosh, bro. Yes. 100%. And not only that, Steve, not only are we seeing an increased demand for new home builds have etched out a special section of the housing market that's only theirs and you can't touch it. If you're an existing home seller, you can't touch this part of the housing market. They have literally cut out through bone and gristle and blood. They've cut out a section of the housing market. And what I mean by that is new home builders are literally the only people that can offer 15% price cut, $10,000 back in closing costs, excuse me. And also Lennar is 4.5% 30-year fixed. Pulte was 5.25%. So there is a lot more demand when it comes to new homes versus existing homes because the payment's $600 lower and it's probably $20,000 lower to move in. So if your payment's $600 lower and it's $20,000 less to move in, people are going to do it because that's all they can afford to do, right? Good question, Steve. Thank you for the support, brother. I appreciate that. All right, guys, we're going to go into our next thing here, which is our video right here. Okay, so our next video is another former Fed chair, his expectations on what's going to happen towards the end of this year and why. This is going to be a little bit boring, but he's going to bring up some good points here as a former Fed chair. I hope you guys enjoy.
What was your take on Jay Powell's comments? Did you come off with the sense that he was hawkish or dovish?
I came off the sense that he was straight down the middle, and here's why I say that. He observed that indeed policy is already restrictive. He observed that they're making progress towards their goals. He observed that, and importantly, they're making progress towards both goals. And he said they had to be prudent or cautious in how they proceed. So I think in terms of the short term, it felt more like a wait and see speech, no movement in November. He had to say, as he did, over the longer term, the economy continues to be strong and they're prepared to move. So I think I wouldn't describe it as hawkish. I think it was straight down the middle with probably not much excitement about moving in November, open to moving if necessary, one more time this year or maybe early next year. So I don't know if that's hawkish or dovish. I think he's trying to take it straight down the middle.
I think a lot of people are trying to figure out if it was hawkish or dovish as well, Roger, in all fairness. I do want to ask you about his comments about bond yields. He basically said, and I'm paraphrasing, I'm not saying exactly what he said, but he says it looks like the rise in bond yields is doing some of the Fed's work for it. He believed that they were rising for what he called the right reasons, not just because people believe the Fed is going to take action. What did you make of those comments?
Jeez.
I think two things. One is, yes, they are not anxious about it. I've heard a number of Fed officials in their public statements saying something very similar, that because the 10-year and bond yields in general are higher, that may be doing some of the work for the Fed. I was surprised that he said it had nothing to do with Fed expectations or expectations of Fed policy. That's almost never the case. But he is right, there are other factors as well, including an expectation that the economy is going to continue to be relatively robust, as we've seen from incoming data. And I think he mentioned appropriately, fiscal policy. The government is having to issue quite a bit in the way of Treasury securities to make up for the spending that's going on.
There's one change in tone from Jay Powell. I know you noted this as well. We had initial jobless claims out yesterday, lowest level since Q1 of earlier this year. And he didn't really highlight that. In previous times we've heard from Jay Powell and other Fed officials, they've really cited tightness in the labor market as inflationary. This time, didn't really talk very much about it. What did you make of that?
I made of it exactly what you said. So one of the reasons I answered your first question is straight down the middle, is things he didn't say that he has historically said. One, he did observe that there is some tightness, but the labor market seems less tight than before. Two, he didn't talk about what's called, sort of super core inflation, which was one of the things that he had been talking about in the past. So I observe, as you did, some of the things that were not said were, to me, pretty telling. And that's why I came to the conclusion that probably not a move in December, but in November, but ready, but not that decided about a move in December.
All right, so to the big question now, Roger. I think a lot of people are probably asking you for advice about this. When do you expect the Fed to actually cut? People are saying, of course, they have to stop hiking before they can cut. But when do you see a cut at least possible? Do you see it in the first half of 2024, the second half of 2024, at all next year?
I think my view has been probably not next year, if next year at all, certainly towards the latter end of the year. First half, absolutely not in the cards. Depending on how things play out, that next hike, the last hike, might not be December, it might be beginning of the year if the economy is proven to be strong enough. So I think it's highly unlikely to see a cut next year. If we do see one at all, it would certainly be the second half, certainly not the first half.
Let me ask you a more longer-term question. Jay Powell, and again, I'm paraphrasing, essentially said, and this is what I took out of it, that we might just be in an environment where we're going to have a higher neutral rate. It'll just be higher from now on. What did you make of that?
I agree with it, frankly. I think many people do not recognize how unusual the last 10 to 15 years have been. It is not meant to be that money is free, relatively speaking. Getting to what's called the zero lower bound, where the Fed set Fed funds target is at or close to zero for long periods of time, is abnormal, not the normal thing. So I would think that the possibility of rates being, frankly, back to normal, higher than they have been historically for the last 10 to 15 years, but similar to what they had been earlier is very much in the cards. There are a lot of forces that suggest that might be the case. So I'm in alignment with the thought that, we should not get used to money being free. That was abnormal,
Okay.
and we should expect more normal pricing for money all along the yield curve.
I liked a lot of things he was saying. I really do, especially the fact that he basically said that interest rates weren't supposed to be that low for so long. But also what he was saying that even if there's not a second rate hike this year, that it is there's a probability of another rate hike at the beginning of next year. I thought that was really revealing. And then plus also when they asked him, when do you think that the Federal Reserve will cut rates? He's saying not at all next year. He's saying if they start cutting, the soonest it will be is the second half of next year, which is maybe okay because the second half, it beats the beginning of home buying season. And the other thing is they're not telling us, guys, and I want you to understand this, they're not saying how much they're going to start cutting rates. It's possible they only cut rates 10 basis points. It's also possible that they cut rates 50 basis points. I really believe the rate at which they cut interest rates will depend on the economic hardship at that time. So if there's not unhinged unemployment, if there's not a horrible economy, all these bullets saying great economy, great job market, we're going to have higher rates for longer. And when they start cutting, the cuts will be very minute. But if something completely breaks, total meltdown, commercial real estate, we get a bunch of inventory in the housing market, prices start dropping, at that point, they will, in my opinion, they will cut rates drastically, probably up to, if they're, again, even if there's like a credit event, 75 basis points, right? So what I'm really trying to say is that's going to hurt us all in some way. And in order to really be a winner, you guys, on the other end of this thing, we have to be prepared to take that hit. We have to be prepared to potentially lose our job. So again, on the sideline, we need to be preparing right now for the hardship that's right in front of us. Is it here yet? It is to some people, if you're in real estate or if you live in Austin, Phoenix, Las Vegas, but not in whole, right? All that's happening that we're all feeling right now is the unaffordability. And we can see that right here. As far as prices, I wanted to show you guys this real quick because people are saying that the housing market has been incredibly resilient. And I want to remind people, if the housing market was incredibly resilient and we made it was a beast rebound. I'm not saying it's not. The dead cat bounce that I believe it was beast. Okay. So it was beast, historical, unprecedented actually. But it wasn't so strong to where the housing market fully recovered. I want you to know that the housing market did not fully recover. And now we are on the way down with prices. And I suspect those price decreases will continue. But look, guys, at the peak of the market, they were only able to recover this much from the peak. I'm sorry, the peak of this year compared to the peak in the market, which is 2022. You guys, half of California is still down? Seattle's still down 5.2%. Austin, 13.5%. Look at this. East Coast doing okay. East Coast doing okay. Florida's starting to get hit now. Finally, Florida's starting to, you guys, the housing market's not particularly strong right now. The housing market is extremely unaffordable and extremely toxic. We're going to listen to one more video, but, let me tell you guys this. People ask, like, Travis, do you think I should buy right now, right? And, if I'm going to give my permission, or rather my blessings on someone purchasing right now, there's a checklist. There's a checklist, okay? Starting with wedge and cash flow, like the really important things. Having the realistic expectations that you may be stuck in there for 5 to 10 years, but also comfortably affording the house in an area that you love. If those things persist, your mortgage payments may be under 25% of your gross income. All right. Maybe the finance okay. And also if you're paying more in rent, obviously if you're paying more in rent, it's a little bit different of a situation. But I'm still risk off, you guys. I'm still not helping people. I'm not originating. I'm not representing people. You can see it on my records. If you go to track my licenses down, you can also, if you go to my mortgage license, you probably see hundreds of transactions I completed, but I'm still risk off. We don't know what's going to happen. I believe we have probabilities and we kind of estimate what's going to happen. But either way, guys, we're going to listen to our last video. Okay. And our last video is going to go into the tight supply. So there's a lack of supply. Now this person thinks as a result, and I want you to hear this. It's important to hear what the other side of this argument is saying. It's important for our strength. Okay. So he's going to say lack of supply, no crash. But understand, this guy is, I think he's the CEO or the president of Mortgage Bankers Association. So the financial bias is overwhelming. There's an overwhelming financial bias. But nevertheless, included in this financial biasness, there's certain bits and pieces of value that I think it's important to pay attention to. So that's kind of why I want to listen to this as well. So you guys listen to this video. I hope you enjoy it.
Everyone in rates land, Matthew, has been saying the Treasury yield, it's over. It's over. I've been hearing this for weeks, and it just keeps going. So I hope you're right.
I mean, you know, we don't know exactly when it's going to be over, but we do hear a chorus of Fed speakers, especially last week, in a very notable way, saying that they are restrictive and that they can wait and see what happens with the policy filtering through to the economy. And if that's the case, then there's only so much more that the long end of the yield curve, which is more tied to mortgage rates, is going to rise before we have hit the ceiling.
I tweeted the 8% mortgage rate yesterday, purposefully to see, you know, just what kind of psychological response there was. And nearly everybody, Matthew, responds by saying a crash is coming. A crash is coming. They either say it's unaffordable, an entire generation is ruined, or they say a crash is coming. What are your thoughts?
Oh, so many thoughts. First off, what Diana was just saying about supply is critical. So we need to decide how we're going to define a crash. Are we talking about a crash in home values? Because if supply is the tightest since the 80s, then it's really hard to get values to crash. 8% rates obviously pose a big problem for first-time home buyers. So, you know, that is a big issue. But when I think of crashes for the housing market and for the mortgage market, I think of things like 2007, 2008, and we're just not seeing the same sort of dynamics there in terms of risky loan profiles and risk-taking behavior among borrowers and pretty much everybody else in the sector.
Yeah.
So I don't think it's a crash.
Just real quick, guy, he's talking about risk-taking behavior. And if we compare the risk that people are taking now compared to the great financial collapse, it's way more risky. No, it is way more risky, not like double, but it's way more risky from a PE, price to earning ratio, and a payment to income ratio. It's worse, you guys. It's more risky. I'm not saying before like 2022. I'm saying right now. So I don't know what this guy's talking about. I'm going to keep going here. Sorry.
I think it's painful. I think it's ugly. I think the volume is tremendously constrained, and it's not pleasant for anybody that's either trying to buy a house or involved in the sale or financing of the house. But I don't see how it crashes the market. And in fact, if I needed somewhere to live and I was going to make a monthly payment right now, I would get a mortgage and buy a house.
Well, Diana, I always feel a little bit Dante-esque at the moment. I think about the housing market as just like the bottom of hell completely frozen over. And we can argue about who the figures are, you know, stuck in ice there. But that it feels a little bit more like that. Like it's almost like activity is just grinding to a halt.
Yeah, it's the real estate agents who are in that, circle of hell that you're talking about.
I was going to put the policymakers there, but yeah.
Them too. But look, yeah, and you talk to the real estate agents, and what they say to me is, I've never seen anything like this before. I've never seen it frozen like this. We went to an open house, and we saw a lot of folks came out to the open house, but they were really just looking. They wanted to see if home prices were starting to come down. They wanted to see what the competition was out there, if there were other people, looking in their price range. But all of them said, yeah, well, I'm not going to move right now. I'm not going to make a move or make an offer. I just want to see what's going on. And that speaks to this very strong demand. But I'm also interested in what the builders are doing with the mortgage rate write-downs. And Matt, I wonder if is this going to pose any risk to the overall housing market now that we see more and more builders buying to write down the mortgage rates for their buyers?
All it really does is sort of artificially props up values just a little bit. If builders are paying points, with their excess profits to buy down the rate to help buyers afford a little bit of a bigger house or more house in terms of the mortgage amount. But I don't know that it causes any sort of systemic risk. It's something that sort of nibbles away at the margins of valuations. But yeah, I also wanted to say to your point, Kelly and Diana, that it is ugly. I mean, I don't think anybody in my community of mortgage originators would disagree that in many ways this is worse than the great financial crisis in terms of volume and activity.
Okay, guys. So I'm going to end it there. So he's acknowledging it's, worse. I mean, he's saying that it's worse than 2008, which it is from a sales and transaction standpoint. And I've heard that narrative being pushed. Like we have a crash right now, but the crash is only going to be in transactions. But also, like we have to understand the cycles here. Like that's stage 2, stage 3 prices, stage 4 inventory. So stage 1 interest rates, stage 2 sales and new construction. So like these guys want to stay and hope, and maybe it happens. I don't think so, but they want to stay on stage 2. They don't want stage 3 and 4 to happen, even though it did happen already last year. But that shifted this year when they injected all the money into the economy. It shifted, but it is what it is, you guys. I mean, appreciate you, brother. You didn't have to do that, man. Thank you for the support. Really appreciate it. I want to pull up, appreciate that, brother. You don't have to do that. I wanted to pull up Deuster's comment because he had a really good, here we go, here it is. Okay, so here's Deuster. I'm going to go into the Q&A right now. Sorry for my throat, you guys. Here's Deuster's comment. Man, Deuster, you make me think, brother. You make me think. All right, so how much value do you add to waiting 2 to 3 years, waiting for the right home? Especially when you have kids involved, your prime window is small. Here's the thing, Deuster. My children, I mean, realistically, whether I own a home or rent a home, my children are going to have a great mom and dad. We're still going to love them. We're still going to pray with them. We're going to teach them how to be good people, right? So we don't want to assume that our life is going to be better by purchasing right now. Also, in this comment, I don't plan on waiting 2 to 3 years, Deuster. I made an offer at the beginning of this year, which, by the way, you guys remember, all last year I was saying I'm going to make an offer in February. It just so happened that February was the best time to purchase in what? 3 years? 3 years. So anyways, I mean, I don't think that we should like say 3 years is how long we're going to wait. 2 years is how long we're going to wait. I think we should wait until we find what we want. Right. And I believe that as consumers, we should add into our desires, wedge cash flow. The more that we're treating our primary resident like an investment, the better off we are. Trust me on that. And I know people are just buying for livelihood. And also, Deuster, but I hear your point. And I think, Deuster, I think most people are going to fall into what Deuster's saying. I really do. And it's sad. I think most people are going to fall into what Deuster, but I think you guys are not. I think you guys are going to be above this. Again, Deuster, I don't think we should wait like X amount necessarily. I think that we should understand what we want, increase our purchasing power, and find a great deal. Wedge cash flow, which there's just so rare. You know what the market crash is, Deuster? The market crashing is it just means it's easy to find a great deal. That's what a market crash is. Right now, it's hard to find a great deal. When it crashes, easy to find a great deal. But what's hard? Qualifying. Why is qualifying hard? Because the economy is in turmoil. Credit restrictions, job loss, right? That's why I'm saying stay ahead. But Deuster, I think it's something in between, brother. Just really impressive insights this morning, Deuster. Really impressed, man. All right, guys, we're going to go into some more here. Okay, here's a comment from Nightcree. Nightcree, I appreciate your support, brother, from the beginning. I saw that you took the home buying course. I hope you guys are just learning. Like, I know it's boring, the first part, but I hope you guys are learning, and I saw that you did that. Real estate is a big part of GDP lie. They won't want to shake it down. And the reason I brought this up, and he may be right, I mean, there's a lot supported on the values of homes. But I think like we saw back in 2008, 2009, it doesn't matter what they want, right? We need things built with like fundamentals so that it sustains. The fact that they don't want it is making it worse. It's making the crash worse, in my opinion. Because again, remember, boom bust is healthy. Why they keep trying to push out the bust? It's just making it worse. It's a healthy part. Another great comment. I already have 2 years and an extra $1,800 a month to add to my payments if I ever find a home. I'm bringing this up because I think the reason why you said this is because you took my home buying course and you understood that in order to use listen, this is important. In order to use additional income that's outside of normal W-2 income. So if it's outside of normal W-2 income, like a second job, self-employment, commission, overtime, or bonus, you have to have traditionally a 2-year history of receiving that income in order to use it to qualify for a loan. So the sooner you get started, and that would be one of my biggest recommendations, is to try to figure out a way to make as much money as possible. For example, guys, Johnny. You know, some people love Johnny. Some people are like, oh, he's just a troll. The reason I always talk about Johnny is the guy is incredibly smart and he's ahead of me as far as like his ability to purchase right now. The guy could buy a house all cash. Totally lost my train of thought. Dang it. I was trying to build you up, Johnny. Totally lost my train of thought though. But anyways, oh yeah. You know what Johnny did? He made a hat company. He's like, oh my God, Travis, I made thousands of dollars a month in his hat company. I'm so proud of Johnny. But Johnny, remember, in order to use that income on a loan, you have to have a 2-year history. Okay. And watch the decline in income. You can't have a specific decline in income. Anyway, sorry. Rent is affected by rate hikes. So this is a question from Les. Les, it's nice to see you as always, man. Usually you are here first in the mornings. I haven't seen you in a bit, but is rent affected by rate hikes indirectly? I would say in this situation, yes, because the rates went up so much and there was a lot of cap rates that were doable because of low rates. So basically, guys, when rates go up, it costs more money for landlords, especially new landlords. So the premise is because it costs more money for the landlords, they pass the cost to the tenant. Okay. So indirectly, I'd say, yes, rate hikes do have an impact on rent. However, I think rents are going to continue to go down because of the overabundance of supply. There's so much supply in the long-term rental and in the long and short-term rental market. It's mind-blowing. I think, was it 40 million or more houses right now owned as a rental? Omaha. I got to give this man some respect. I beat him up a little bit. And Omaha, I do that because I care. If I didn't care, I just wouldn't pull up your comments. So I think Omaha's starting to come around. I think he's being more cautious. I'm proud of you for that. I don't know because we haven't talked. But great insight, Omaha. Let me ask you a question. Moving forward, don't you see developers building smaller homes or townhouses or something more affordable so buyers can still purchase? They're already doing that. Okay. But if you look at the square footage, okay, because a lot of people are like, median sales price only went down because they're building small houses. Okay. Right. If you go to the Redfin square footage and look at the average square foot of houses sold, the square footage didn't go down this year. The square footage went up with prices, not down. That's crazy. So yeah, Omaha overall, though, I 100% think they will. I 100% think that they're going to try to do smaller houses and try to make things more affordable. But we really need prices, not necessarily the sizes. But go back and Redfin Omaha and look at the stats on square footage. Mind blowing, actually. So again, they got bigger, not smaller. Jedi, love the name. You see Darth Vader right back there? Next to Michael Scott, there's Darth Vader. I love this show. How do you find out how many new home builders there are in Atlanta metro area? And thank you again for a great show. So I want to show you guys. I'm going to go out on this comment, okay? I'm going to show him how to do this himself, where we're going to look at Atlanta. So he wants to know, how do you look for new homes in Atlanta, right? So being that I flew around to the country, let me show you how I did it, Jedi. So one of the things that I do is I start with Lennar, because Lennar gives us easy, accessible information, right? So they give us details, whereas like Pulte and look at this, C4.25 DR, they don't. All right, so first of all, I'm going to go to Lennar, because generally if I can find a Lennar community, there's going to be a whole bunch of new builders, and then I'm going to use Google Maps. So where are we looking? Atlanta. So let me look at Atlanta first of all, okay? So I'm going to Lennar first, and I just want to see the status. Boom, look at that, $20,000 price cut right there. All right, so here's the status of homes near Atlanta. Look at these price cuts. This is, dang, they're dropping prices in Atlanta now? Jeez, okay. Okay, I'm sorry. Okay, so here's the map from Lennar. This is my starting place. So if I scroll and I'm like, okay, look at this little cluster, or look at this little cluster right here. Okay, so there's a little cluster, South Atlanta, right here, okay, by Sharpsburg. Now, usually, oh, you guys can't see that. I'm going to remove this. Okay, so usually I'll try to find where the biggest cluster of Lennar is. All right, so I'll look for the biggest cluster of Lennar, okay, which appears to be, is that, jeez, I'm just going to put Sharpsburg. So then I'm going to go to Google Maps, because that's only Lennar. I want to find more. Okay. I'm telling you guys, this is exactly how I do it when I'm traveling. And then I'm going to go to Google Maps. I'm going to put in Sharpsburg. You guys should do the same thing. Sharpsburg, Georgia, right? Right here. Okay. So I'm gonna go this layer right here because I like to see if it's new build or not. Okay, so here's the Sharpsburg area. All right. So now that I've kind of pinpointed this area, so there's like new construction here, I'm gonna remove Sharpsburg so it doesn't like confine me to this area. And all I'm gonna do, look at this, guys. All you have to do is put in new homes. That's it. And look at now I have all these other new homes. Look at this. Okay, you see how I set that up? Let me search this area again. Look at that. Okay, so there's Atlanta. So, and I can also like search this area here. And I mean, look at that. So the way that I find new homes is actually on Google, but I try to pinpoint like master plan communities from Lennar. And again, what I would do is like these squares is usually a big community. So I'll like zoom into this square right here and say, okay, what's going on at Creekside, right? So what's going on at Creekside? Anyway, so that's how I'll do it. I'm not sure if that helps. Hopefully that helps. Hopefully that answers your question. Hopefully you guys are using the data. There's Johnny right there starting a business. I love it. I mean, start a business, guys. You need 2-year history. Start a business. That's only going to help everyone. Welcome, Andrew. Welcome. Last thing, guys, and I'm going to get going here. The home buying course, it is a little overwhelming. I am a one-man army. I have a huge family, and I believe in balance, not just taking over the world. So by this weekend, I should have chapter 1 ready to be released to public. There's a couple things I have to adjust in it, and which is why one of the reasons why I put it out for our members first. But I'm going to have that hopefully ready by this weekend, and hopefully I'll have the whole thing ready by the end of the month. But I'm not sure if I will. But anyways, guys, happy Friday. Have a good weekend. Don't go out and drink. Stay home and rebudget. And other than that, if you're out there investing in real estate, you guys already know I wish you luck, and I hope you